Hey everybody, thanks for stopping in. I wanted to show you something that I've been researching for the past few months about housing developments being bought up at inflated values by investment companies and basically creating very high priced comps for then future sales. And that these are being put together in a very interesting way. I'm using the word interesting very loosely here. And what I want to show you, this was some research I was actually doing. I have some different neighborhoods around the country, mostly in the South, that I was looking into and making my own data points. And it happened to be that another YouTuber came out targeting exactly one of these developments that I had come across myself. And what is important about this is don't focus on the super minor details. I will show those and some other research I was doing in regards to them, but mostly on just the overview of what went down. So what we have here is
Goldman Sachs
backed firm buys entire Florida community for $45 million. And sorry about that. I will play his voice here in a second. He does a great job here in just a couple minutes showing the exact details. So what we have here is a pair of Goldman Sachs backed ventures gobbled up an entire rental home community. So it wasn't a rental home community initially. It was single family homes built for individuals. But they bought the entire community for $45 million. And here is what is really important is Fundrise and Growth E-REIT picked up the 87 single family homes. So these were investors additionally, and these companies raise funds in small increments from retail investors who don't have enough money to go out and buy their own home, maybe put a 500 or 1,000. I've been actually approached by these through ads and through targeted marketing to invest a few $1,000s and be part of these investment portfolios. And I'll show you how dangerous this is here. This is just highlighting. So this works out to $525,000 per home. And these are just basic Rambler homes. I mean, they're nice, they're new, but this is evidence of how they are creating a false value on these homes that are beyond belief. Because these actually did sell for $525,000. So they therefore then become 87 comps, not a single one house off comp at 525. You now have 87 homes at 525. And this is the guy from Reventure. So let's listen to what he says a little here before he jumps into the next section.
To $525,000 per home. That purchase price by these Goldman Sachs backed investors is an astounding 52% higher than the typical value of a home in Palm Bay according to Zillow, and is more than 40% higher than the homes that are selling for next door. If we go here on Zillow, you can see the single family rental community that these investors bought right here, and right next door, D.R. Horton, the largest home builder in America, is selling homes to regular buyers, and I gave him a call and found out I could buy the same size home for $300.
So right across the street where an investment fund did not buy up all the houses, they are listed for $371,000. There's a $385, $390. So the real price that the builders are charging in this neighborhood is the high 300s. Yet for some reason, Goldman Sachs, along with those other companies, decided to pay $525,000 for homes that are the same quality build and the same basic square footage size. Unbelievable, people. Think about what this is doing. So instead of having a lot of comps in the high 300s, you now have some comps in the 525 range that has never occurred before in this area for these size of homes. He then goes in to show this is another set of statistics that are incredibly important to get your mind around. This is investor home purchases. And these get registered when a person buys a home, when they apply for a conventional loan. So the conventional loans are tagged whether they are primary residence, second home, investment property, rental, all of those things. I want you to think about something here that's really big of what's going on. So, and this is just in 2019 and 2020. This is the number of annual home purchases in the United States of America that were invested on an investment loan. And you would only choose an investment loan if it was an investment property because you have to pay higher fees, higher interest rate, all of that. Prior to this, it was in the 6 to 700,000 unit range. So we had already made a stair step up in 2019 and 2020 to this new level. And I believe that this is fueled by the Airbnb frenzy, and that people believe that everyone should have 3 renters renting from them. The ratio of homes that is starting to be purchased by a much smaller pool of individuals who have wealth on their side at this time and leverage is getting magnificent. So this is something he doesn't talk about, but it's something that I noticed. So last year's home sales, 2021, there was 530,000 more homes sold as investment properties than the previous 2 years. And like I said, you go back even more, it was less and less. This is a record high. Let's pretend that the investors, that rates weren't in the twos and twos and a halves. Because what happened is these investors refinanced their primary residence, lowered their payment by $500 a month, and took out $100,000, and then found it very easy to buy an investment property. And I'm not saying that they did it wrong. That's a great move when you're lowering your overall expense and able to buy another house. I just went to look at these numbers here. If those 530 additional homes that were bought as investment homes, if the rates had been kept in the 4 and 5% range, that, number one, that would not have occurred. People would not have found interest in buying a investment property that had, let's say, an average $3,000 house payment, and the rent is only $2,000 or $2,200, which is the national average. But because the rates were in the twos, they were able to buy these and have a house payment of only $2,000 and put a renter in for $2,200. If those 530,000 houses would have been available and not sucked up through the investment home purchases, that is over a full month, about 1.25 months of inventory. So instead of America for the past year and a half running at a 1 month inventory, 1.5 month inventory, these houses would have been part of that pool of inventory. And America would have had about 2.5 to 3 months of inventory. We would not have had any of this frenzied bidding war, house shortage. I'm telling you, we are not short 5 million houses in America. This is a fallacy. We are only short 500 to 700,000 houses in America, because then we would have a balanced market, and that's all you need is a balanced market. We aren't consuming 1 million more houses than there is available, as they're telling us. This right here was the consumption of that. We had a balanced market in 2018 and 19 prior to this crazy jump right here. So thank you for letting me focus on that point. I did want to get that across. He goes into that in a little more detail, showing this was home sales by type in all of America. So what you can see here is this is people buying houses to live in. It actually declined in 2021 from 2020. And this is why I was predicting since January of 2022, and I'm pretty sure my predictions are going to come true. They were opposite of everyone else. People were saying that housing sales were going to top 6 million, 6.2 million, 6.4 million. I say they're actually going to drop approximately 10% from 2021 to 2022. You watch, by the end of the year, home sales will be down. And the reason will be is the home buyers are tapped out. That's why they started dropping right here. We may only have 4 million home sales for primary residences, and we'll have to see what happens to the investor. I imagine this number will shrink greatly, maybe even drop below these numbers because investors are not buying now. Investment home rates are in the 6 to 7 range, and you're talking payments that are over $500 to $1,000 more than what you're going to collect in rent. And that's just not something that someone logically would make that decision. So he talks a little bit more about that here. He shows, I'm going to turn him back on here.
7 single-family rentals. Looking at the capital stack here, which comes from Fundrise, the company which ended up buying.
So the capital stack, what he's showing here, the total purchase price was $45,700,000. Goldman Sachs put up this money here, 24-1. Kind of interesting, huh? Barely more than half, 52%. And then Flagship Real Estate Fund and Growth REIT 7 put in this money. These people are at the very bottom here, and this is how they 100% funded this price. Remember, $525,000 per house, because I'm going to show you something very interesting. Remember this number right here. Goldman Sachs put down $24,100,000 of their own, because it's a very telling thing they did
His
that.
property, we can see 24 million of the funds to buy the property came from a senior loan, most likely Goldman Sachs, accounting for roughly 53% of the purchase proceeds, while the remaining 47%, the remaining 21 million, came from Fundrise via crowdfunding equity. Now you might be saying, what's crowdfunding equity? Well, that's kind of like a GoFundMe page for buying a real estate property. Fundrise goes out there to their retail investors and says, hey guys, we're buying this property in Florida. We need to raise some money. And through a pool of hundreds of thousands of investors investing $2,000, $5,000, $10,000, $15,000, they add up enough money to finally complete the acquisition. And so the crazy thing about this purchase in Florida, as I'm about to show you many of the other investor purchases around America, is that while they use Wall Street debt to finance the transaction, they actually raise the equity mainly from small-time retail investors who want to be able to invest into the housing market, but who might not have the money to purchase a home for themselves. And a lot of you would be surprised to know that of the 1.4 million homes.
So he goes in to show some more breakdown, and once again, this crazy number here, this crazy jump. And I believe that this is fueled somewhat by the small-time investors. They have gone after him with these small accounts, collecting $1,000, $5,000, $10,000 from different individuals. And what I want to show you here is this is these companies. This is one of them. This is Fundrise. And this is where you can read about what they do. Their flagship real estate fund. Remember, that was one of the investors in this portfolio investment right here. Flagship Real Estate Fund provides investors the opportunity to invest in a diversified pool of high-quality real estate assets. Now, they don't say at a good price, but high quality. And this does not make me happy. That I'm telling you, because I'm going to show you here. You're like, what is wrong with it, Jason? And I'm going to show you exactly what the game is they're playing. And this over here, I'm showing eREIT 7. So eREIT LLC is just a LLC, Delaware Limited Liability Company. They are also the other ones who invested those funds. And here's where I'm going to blow the lid off of what's going on. Right here, small investor crowdfunding REITs scam alert. And this is me. Here is what went down on this investment where Goldman Sachs provided the 52.7% down. So they bought these houses for $525,000 each. I'm going to show it on a per house basis. So the bank loan they got was $277,000, right? Only look at this column right here, 53% loan to value. Then additional medium-sized investors, that was through the Fundrise, they basically put up 42%, which means they put up $223,000 per house. If you're doing this on a per house basis, and the small minimum investment crowdfunding investors put in $25,000, they were 5%. If you remember. Let's go back to his video just real quick so we can show these numbers. I'll get to that chart right. It's right here. So here you can see 24,100,000, 19,440,000, 21. Here's their percentages: 42% and 4.7. So these are small little people thinking they're doing a really smart thing, getting involved in a real estate fund that's buying single family homes. But I'm going to show you how they are going to get destroyed. And Goldman Sachs and these fund groups here already know this. It's a total setup. And here is why. If you're in the lending business or the purchasing of investment properties, you will know that to get a prime first mortgage on an investment house, the most that you are going to get lent to you from a bank is 75% of the purchase price. So why in the heck did Goldman Sachs not get a 75% loan to value on this $525,000 purchase price? I mean, if they think those houses are really worth that, wouldn't you want the prime front end of the financing to be $394,000? Instead, no, they chose $277,000 and rolled another $248,000 into these small-time investors. I'll show you why. Because they believe the houses are only worth $369,000. And you'll say, Jason, why? How did you come up with that number? Because it's exactly the 277 is exactly 75% of that. So they did do a 75% loan to value on the actual value of the house. And then instead of, because they didn't pay 369 and these guys put in 25% or gals, so technically the 223,000 that this fund put in is 60% of the value of the house. Goldman Sachs does not care because they only got their risk is only at this level right here. They're in first lien position. And the small guys are down here at 5%. I believe I actually have that wrong. I do apologize because I didn't calculate that over. Give me 1 second here. Let's take that 25,000 and divide it by the 369,000. Sorry, we have 6.8%. My bad, I do want to be accurate. So we're just under 142%. So the funding on this in reality is 142% of the value of the house, but by them paying 525, they hit it and say that no, we financed 100%, financed here, and the rest was crowdfunding. And the other proof in the pudding is the houses right across the street are selling for 371,000. So you already have comps that are selling for significantly less. If this house stays flat in value and they go to sell this in a year or two, just whenever time frame, you lose 10% in sales commissions. Guess what? Goldman Sachs is going to get all their money back because that leaves about $335,000 to be distributed. So this will get paid off. These guys down here will only be getting $35,000 back on their $248,000 investment. They're only going to get 15% of their investment back. This house has to go up to $575,000 just for them to get 100% of their funds back. I think this is a phony investment. I believe that they are funneling money, this $156,000 difference, to the builder of these homes. The builder had no intention of selling these for $525. They were listed for $370, $380. That's what the price is all over down there. So there is something crazy going on here. Of course, the front end Goldman Sachs is not taking the risk. If they believe the houses were really worth this right here would be a $400,000 first lien. And then these guys would have put less in. They moved all the risk down to these guys. Do you see that? These guys are holding the bag on 67% of the purchase price of the actual value, and the house isn't even worth that. This is just unbelievable. It's unbelievable. And this is going on all over in the South by sucking in a few $1,000s from thousands of people and overpaying for these massive developments, creating massively high comps, trying to push massively high rent. If this game of cards collapses, it's going to be unbelievable.